In this lesson, we're going to talk about the structure of Generally Accepted Auditing Standards, or GAS. And I like frameworks. They are always easier to understand and recall than diving straight into the details right off the bat. GAS can be broken down into three sections. First, we have the general standard, and this covers the qualifications and the conduct of the auditor. Second, we have the examination standards, which discuss the performance of the audit. And third, we have the reporting standards that detail how the auditor should communicate their findings. Let's look at each of these sections a little more closely. The general standards seem kind of obvious, but it's the underpinning of the profession of auditing. That is to say, auditors must have a technical background and practical experience to be competent auditors. You need to know your limits and not take on assignments beyond your capabilities. You also must use due care during an audit, and this means working diligently and carefully as you pull together the audit file. Another element of the standard is that the auditors must be free of bias, and we've discussed why an auditor needs to be independent in our very first lesson. There are various rules of professional conduct, all of which hold independence as a core principle of auditing, no matter which jurisdiction you're practicing in. And we're going to talk about this important topic in another lesson. The performance standards require an auditor to use a risk-based approach with their audit. We'll spend time understanding what a risk-based approach means and how you do it. But suffice it to say, a risk-based approach means the auditor identifies areas contained within the financial statements that are of the greatest risk of a misstatement. After all, that is what the auditors are expressing their opinion on. A risk can arise for a number of different reasons, such as business complexity, imprecise judgments, susceptibility to fraud, etc. The activity of identifying risks is called audit planning, and it requires a strong understanding of the client's business. Having identified these higher risk areas, the auditor performs work on these areas to confirm or refute what management is representing as true in the financial statements. This is called the audit execution, as it requires the proper supervision of assistance as audit evidence is gathered. The types of evidence gathered will vary depending on the circumstance, as we will learn. And some clients have strong internal controls, upon which we as the auditors can place certain reliance to reduce the amount of audit evidence we would otherwise have to gather. An internal control is an activity performed by the client to ensure that everything is properly recorded. Clients with poor internal controls make it necessary to gather more documentary evidence to support the information that's been represented by management. The reporting standards describe the specific wording used in the audit report. And this is tailored based on the auditor's overall evaluation of what management has represented, the evidence gathered to support it, and in the context of the relevant criteria, which in the financial context is most often GAAP. A standard opinion, or an unqualified opinion, means that the auditors concur with the information that management has presented. Variations of the standard opinion can arise when either the auditor doesn't agree with certain positions taken by management, or when the auditors have been unable to gather sufficient evidence to support making their unqualified opinion. In the last lesson, we introduced this notion of quality control, which was largely driven by the accounting bodies and the regulators, which are enforced through practice inspections. But how does an audit firm ensure that it meets the standards that we've just discussed? Well, there's 9 elements of quality control to consider. And if you were to set up your own public accounting firm, these would be the sorts of things that you would have to consider prior to accepting your first client. First, you'd need to establish a culture of audit quality. This broadly covers everything from leadership of the firm to the development and implementation of strong policies and procedures. Secondly, you would need to establish mechanisms to ensure ethical behavior is ever present. Consider the principles of integrity, objectivity, professional competence, due care, confidentiality. The failure on any of these would jeopardize the firm's ability to continue operating. Third, Independence is so important that it deserves its own special consideration for each and every engagement. Consider such things as when and whether you can offer non-insurance services to audit clients, relationships with clients, and fee considerations. Fourth, your firm needs to be choosy in who it accepts as clients. Your firm needs to evaluate management's integrity, as well as the firm's competence to meet the needs of the client before accepting or continuing an assurance relationship. Fifth, your firm needs to establish human resource policies because at the end of the day, auditing relies heavily on its people and their judgment. And if you don't have good people, you're going to expose yourself to litigation. Sixth, accounting and auditing standards never sit still. The nature of the profession dictates that you and your staff will need to continuously undertake professional development to stay current. Seventh, you need to establish an audit program that can be tailored as necessary to achieve GAS. These policies and procedures will be extensive and incorporate such things as the use of audit software, supervision, review of work, and the use of specialists. Eighth, you'll need an internal process to ensure the quality control during and after an engagement. Your firm will need policies on when to use second partner reviews, technical reviews, or other compliance type activities. And last but not least, you will need a documentation policy around the extent and retention of documentation. Now you get a sense of why it is that firms charge out staff and partners for hundreds of dollars per hour. You just don't suddenly wake up one day and decide that you're going to become a public accountant and start your own public accounting firm. For those who persevere, it's a wonderful and highly profitable business model, but you need to do it right. You need to look no further than the demise of Arthur Andersen after Enron to see what happens if any of these elements are compromised. Arthur Andersen was one of the world's largest public accounting firms prior to the Enron scandal, but because the firm's undisciplined execution of GAS was brought down in the wake following the scandal. That's the nature of public accounting. One bad audit, one bad partner can jeopardize the entire organization. Think about this for a moment and let your mind weigh in the gravity of the importance of these principles. And until next time, don't stop till you get to the top. When you get to the top, don't stop.